DJDMD. This is a rapper that I listen to. He's not as well known. He has a track called Mr. 25/8. And it goes like this. I'm DMD and I'm a hustler 25 hours a day, 8 days a week, all work, no play. That's how I feel quite a bit of the time as a dividend growth investor. That's going to be part of the theme of today's video because I'm going to go through later in the video my goals for 2019, and I'm going to set the stage with my goals for 2020. But I have a lot to cover today. I'm going to cover subscriber questions. I'm going to cover a portfolio update and some stocks that I've been purchasing recently, and a bunch of other stuff. And in fact, I want to jump right into it now. I'm going to share with you on the screen 3 stock purchases, dividend stocks that I purchased recently. So check this out. The first one is 3M. Not as many people right now are talking about 3M. It's come back up a bit, but I continue to average in. I continue to average in because I believe it's at a fair value. One of my strategic goals for 2019 has been bolstering my industrial exposure in my portfolio. And quite frankly, I am a bit underweighted in the industrials. And I look, hey, we're in December. There's still a month left to hit my goals, to accomplish my goals for 2019. So I'm focused on the goals. That's one of the reasons I'm adding to 3M, because it's strategic for me. It's my number 10 favorite stock of all time. And it has been a strategic goal of mine all year to build this position. And so why stop now? Anyways, I bought some more 3M on November 22nd. I bought it at $166.33 per share. The forward PE right now, based on the analyst estimated EPS on that tranche, is an 18.38, and the starting yield 3.46%, and the 5-year dividend compound annual growth rate is a staggering 11%, although I don't think that will continue. I think that the rate of dividend increases will probably taper off for 3M in the short run. And so you look at these numbers, you look at what I paid for 3M in this first tranche, or the first recent tranche of my 3 recent buy orders, and you basically see that I'm paying a fair value. I'm not getting a steep discount, but the reason I'm buying right now, again, is it's December. Well, this tranche was in late November, but I am thinking about my strategic goals for the year, and I want to close out 2019 strong. And so you'll see next on 11/29, I purchased some Duke Energy. I purchased it at $88.40 per share. The analyst estimated EPS forward looking is a 5.02, which places it at a forward PE of 17.61. And it has a starting dividend yield of a 4.28% with a compound annual growth rate of 3.52, which quite frankly, I think that compound annual growth rate for Duke could increase over time. I think it could get better because if you watched my recent video where I covered some stocks right now that are a bit out of favor, Duke is one of them. I'll link to this video in the description below. They are growing their revenue. They are growing their earnings quicker. They are doing quite well, actually, in terms of growth rates. And so even though it's trading at a fair value, I decided to put some more money into Duke because, quite frankly, I need to bolster current income in my portfolio. We'll talk more about this later, but one of my goals for 2020 is bolstering my 2020 current income. I need more current dividend income in the portfolio, and utilities are a great way to do that, to drive immediate cash flow. And I like Duke now. And so one thing, though, on Duke I want to mention, some subscribers were asking me, hey, there's some recent news that they're going to dilute shares, they're going to issue more shares. Personally, I'm not too worried about share dilution because there's 2 ways that utility companies, or really any company, can raise funds. They can issue more shares, or they can go to the debt market and take on debt. And so the fact of the matter is, EPS, earnings per share, is going up. The company is doing well. And so if they issue more shares, as long as the earnings per share continue to climb at a nice clip, it doesn't matter if there's more shares because they're driving efficiency per share. And so that's the way I look at it is, yeah, there'll be more shares, but if they're still driving rewards and efficiency for me on a per share basis, I am fine with that. Now, if they were to, by contrast, if they dilute all these shares, they add more shares, and then their EPS growth slows to a halt, then the dilution is actually creating problems for my shares. But as long as they're raising funds through dilution and my per share growth is up, EPS, I'm fine with that. So I don't worry. I don't lose any sleep over that at all. But time will tell how that pans out. So that's the second stock I bought recently. And then most recently, you'll see here on 12/2, I purchased more shares of 3M again. I bought at $169.33. And so the forward PE on that tranche climbs to an 8.71. And the starting yield lowers to a 3.4%. And so these are just three stocks that I purchased recently. And the reason I'm sharing this right now is 3M, it really is indicative of the past. This is my goal for 2019. And so I'm trying to close out the year on a strong note. Duke, quite frankly, is a foreshadow of the future. And so even though it's December, it's not too early to get started on my 2020 goals. And so this buy order foreshadows what I'm trying to do in the future, which is drive more current dividend income in the portfolio. And so I wanted to give that snapshot. I thought it would be a good way to open today's video, but I'm going to jump into a lot of stuff today. I'm going to continue my 21 questions to pay respect to my man, 50 Cent. One of my favorite tracks by 50 Cent. I did a bunch of questions in the last video, got more subscriber questions in this video. So let's jump into it. Another dividend investing video. All right, so question one. This one I'm going to pop on the screen. It comes from my man, DS. I don't know if I wrote down his name properly, but I just wrote the initials DS. So shout out. I like this question. Is AbbVie, ABBV, still a good value, Ian? Oh boy, yes, I think it is. And so this is an interesting one. I think this is a really good lesson. First and foremost, I'm looking forward to 2020. What are my goals this year? I want to drive, or next year, I want to drive more current dividend income now that can be used immediately to pay the bills. I like looking at stocks like Duke. I like looking at stocks like AbbVie. So you can already tell I'm going to be buying more AbbVie in 2020 as long as the prices don't get too much higher, as long as it stays kind of in the 80s. Once it gets kind of in the 90s, mid 90s, high 90s, I probably start losing interest. But as long as it can stay here in the 80s or lower, quite frankly, it's going to drive a lot of current income for me with high dividend growth rate, which I love. But anyways, check out the screen. I got some numbers on the screen. I think AbbVie still is a good buy. And so let's just look at the fundamentals. Price per share is 85 and change. Analysts are estimating an 8.93 EPS. Puts the forward PE at a 9.6. And so that's one of the first valuation metrics I look at, is that forward PE is just really, really low. Just earlier when I was showing my 3M purchases and my Duke purchase, we're looking at PEs in the 17s. And so compare that with AbbVie, which is at a 9. And so 9.6, really good value there. Now, obviously, I've done a bunch of videos on AbbVie. I'll link to them in the description below. I've done extensive analysis on AbbVie. And so this is not a full financial analysis here by any means, but I'm trying to answer questions. So I'm trying to go a little quick because I got a lot of ground to cover. But if you want to see my full analysis of AbbVie, check out the description below. I'll link to the videos. I've done long videos where I spend the entire video analyzing AbbVie, going into painstaking detail. All right, the dividend right now annualized is 4.72. That gives a dividend yield of 5.5%, starting yield. And what's great, they just increased the dividend by 10%. And this is for the effective date, or the X date upcoming of 1/14/20. They just literally in recent months said, hey, we're going to raise our dividend by 10%. I love that as a dividend investor because it gets me yield on cost, which we'll talk about later. This is a bit lower than the 5-year compound annual growth rate of 19%, but hey, 10%, I will take it. And the payout ratio is only 49%. And so AbbVie has room to grow the dividend as well. Now, obviously, there's challenges with this company. I've described them in the past with Humira patent expiration upcoming in the US, and a lot of debt, and a merger or acquisition of Allergan. A lot going on there. There are risks, certainly. That's why the PE is low. That's why the stock is down. But I am willing to take on that risk. I think it is a wonderful bargain still, even at current prices. And so I will continue to buy AbbVie here. I like it for my personal portfolio. And I like it because it fits into that 2020 theme. Like I said, 2019 is kind of about industrials, kind of about top 10 stocks, bolstering top 10. 2020 literally is going to be about current yield. And so AbbVie really falls into that bucket. Now, I want to show you something here. The 2-year high for AbbVie was $123. And so it's still down about 30% from the high. But AbbVie is up. The lowest tranche, the lowest point that I bought it was at $66 and change. And this was just recently. AbbVie is up 28% since that tranche that I bought recently. The reason I am showing this, quite frankly, is this stuff is irrelevant. It doesn't matter where the stock was, where it is. What matters is the stuff I was talking about before, the valuation metrics, the fundamental analysis, where the stock has gone, the chart, this and that. I know a lot of people are technicians. They look at the technical analysis. For me, at least, that just does not matter. It's irrelevant. I like to buy a stock when it's facing troubles. I still would say AbbVie is being down about 30% from the 2-year high, trading at a PE of 9.6. But again, I don't place too much weight on the chart, and I don't get scared away from AbbVie because I'm up 28% from my lowest tranche. I'm averaging up here. And I think that's a really important point because this question, it's kind of, I know what's behind the question. What's behind it is they're asking, Ian, is AbbVie still a value? And the reason for that question is it's up. It's up a bit from the lows. For me, stock chart, again, it doesn't really matter. What I like to look at is the fundamentals. And yeah, it's up from the lows. Yeah, I'm averaging up, but the numbers show me it's still a value. And so it's not as good of a value as it was when I was buying at a PE of 7, but it's certainly still a respectable value, and I like AbbVie. So really good question there. And again, I like it because it fits into my 2020 theme. It helps me explain to myself and to all of you out there what I have in store for next year. And so I'm already starting to think down those lines in December here because it's never too early to get started on next year's goals. It's awesome question. So I want to jump now into the second question from today. This one I love. I love this question because I'm not an ETF guy. And so this got me looking into ETFs because of the question, and it's a good opportunity to educate myself. So my man Roll, thank you for this question, Roll. He said, yield on cost, does it work on dividend ETFs? Because I talk about yield on cost a lot. I talk about how it really works for what I do, buy and hold forever dividend stocks like AbbVie. You already see that in motion with AbbVie. They just raised the dividend. My first tranche was, I bought it at the old dividend rate. Now it's yielding even higher than where I bought it. So yield on cost in action. But Roll was wondering, does this still work for dividend ETFs? And so this gave me an opportunity to do a dividend ETF analysis. I'm going to share it on the screen with you right now. And the one that I looked at is a ETF called NOBL. This is the Power Shares Dividend Aristocrat ETF. And so what this ETF does is it looks at the S&P 500. Out of the S&P 500, they pick the dividend aristocrats, those dividend stocks that have raised dividends for 25 years or more. And so the thing about this NOBL ETF, I like that off the bat, and I like that their expense ratio is low. It's only 0.35%. So each year they take that out of off the top. They're taking 0.35% in management fees. Kind of low, but again, I would prefer that to be zero because it's an ongoing expense that never goes away as long as you own that ETF. Each year, you're paying that management fee. It's just like compounding of interest. It compounds those fees in PowerShare's favor. Anyways, put that aside. What was interesting as I started looking into this thing, before I even get into the yield on cost question, I looked at this the metrics. It's available on their website. They talk about turnover. Their 2019 turnover was 35%. And what this means is 35% of their portfolio literally turned over. They sold stuff, bought new stuff. There's been trading happening. And so I don't like turnover because what happens with turnover is it triggers capital gains. If someone owns an ETF, it comes through. Those capital gains get passed through to the ETF owners, triggers a taxable event, and you're paying taxes. Whereas with my strategy, buy and hold forever, don't sell. I'm paying taxes on dividends as they roll in, but capital appreciation, because I'm not selling, I'm not triggering taxable events. Whereas ETF owners, even if they're buy, hold forever, because there's turnover, this 35% turnover, that is triggering these capital gains that are getting passed through to ETF holders that are going to show up on one's taxes each year. Even though you're not selling your shares in your ETF, they're doing turnover. They're doing turnover on your behalf because they're rebalancing the portfolio. And so I was looking into power shares. I'm like, why are they have this turnover? Well, they have this rule that they weight the stocks in the portfolio equally. And if they're not weighted equally, they rebalance it. They rebalance on January, April, July, and October. So think about it. A stock in the portfolio, an aristocrat, goes way up. It becomes worth disproportionately more on a percentage basis than the other stocks in the portfolio. They have to sell, trim it down to size. By contrast, if a stock in the portfolio tanks and they need to bring it back up to size to be equally weighted with its peers in the portfolio, in the ETF, they got to buy more. And so there's this concept here of rebalancing, which causes turnover. Some may argue, hey, that this is a good thing because they're trimming winners, they're adding to losers. Maybe the losers will disproportionately perform better than winners. I don't agree with that, actually. I don't like to penalize winners. If you've been following me for a while, you know I like to buy and hold forever, and I like to not necessarily add net new money to stocks that are winners or overvalued, but I like to reinvest dividends. I definitely don't like to penalize them. And we just saw from AbbVie, quite frankly, that it's a winner. It's way up. But is it overvalued? No. So that's a case where I want to keep adding to AbbVie even though it's up because it's still a reasonable value. Problem with power shares is something goes up like an AbbVie, it becomes worth more than percentage-wise it should be. They trim the position off and they add to losers. And so creates a turnover, creates a taxable stuff. Personally, it's not for me, but I'm just trying to point out some of this stuff, why I don't do ETFs. Now, the reason a lot of people like ETFs, it's a one-stop shop. You buy the ETF, set it and forget it, you're done. You buy one thing, you own all the underlying things. And so there are pros and cons, as I discussed in my last video, actually, at length. Anyways, that's not even the question. The question is, Ian, does yield on cost work for ETFs? Well, let's look at that. So I went to the PowerShares NOBL website, and I started just looking at data. I wanted to look at full year data, so I didn't look at 2019 because not all the distributions, the dividends have been paid yet. So I looked at 2014 and I looked at 2018 because these are full years. 2014 was the first full year of this fund. 2018 was the last full year. And the reason I want to look at full years is the dividends are a bit lumpy. If you look quarter to quarter, for example, in 2018, in December, the dividend, the payable date, there you're getting a big 42-cent dividend. But in September, you only got 34 cents per share. And so it jumps around. You can see these numbers here. Even back in 2014, it kind of jumps around a bit. But I would say 2018, it jumps around more. I don't know why that's the case. Perhaps it's just based on the cycles in which the underlying securities are paying out dividends. That's what I would probably guess. That's my best guess here. Anyways, when I sum up the dividends for all of 2018, they're paying $1.43 or $1.44 rounded in dividends per share of the ETF. In 2014, they paid out 79.9 cents or about 80 cents in dividends per share. So let's just look at this. The way mutual funds work is there's a price quoted each day. It's called the NAV or net asset value. The net asset value on January 2nd of 2014 was $43 and change. The net asset value on January 2nd, 2018 was $64 and change. So it has gone up. The net asset value has increased, aka the price per share. And so this is a really easy calculation. Let's just look. Starting yield in 2014, if I take the 80 cents almost of dividend, I divide by the 43 and change net asset value. The starting yield in 2014 is 1.83%. Starting yield by contrast in 2018 is 2.24. If I take the 1.44 distribution per share, I divide by the net asset value on 1/2/18 of $64 and change, I get about 2.24% yield. Here's where the magic happens, though. This is important. This cell that says 3.28%, this is the yield on cost. And so check this out. If I take the current dividend distribution per year, which is $1.43 and change, and I divide by the net asset value or the price per share for someone that bought in 2014 of $43 and change, I get 3.28% yield. By the way, this doesn't even count reinvested dividends. This is just simple yield on cost, assuming all the dividends that are taken and spent, which most dividend investors, many dividend investors, they're not doing. They're reinvesting dividends. A lot of us, at least, that's how I do it. I'm spending some of my dividends, but reinvesting most of them still. Anyways, the purpose of this analysis is to show, in reality, that yield on cost, yes, it does work as a matter of fact, not only with individual dividend stocks, but with ETFs as well. Because you can see it right here. You buy it in 2014 for $43 and a starting yield of 1.83%. You hold it in 2018. Someone who's buying it in 2018, they only get 2.24% yield on cost or starting yield because they're buying at a higher price. But for the person that bought Power Shares back in 2014, they're getting a yield on cost of 3.28%, which is higher, a lot higher than someone that's just starting out and buying their first tranche in 2018. And so the purpose of this, again, is to illustrate that whether you go the individual stock route, the ETF route, it doesn't matter. This concept of yield on cost, it still works. This concept of buy and hold forever, buy at this lower rate, and enjoy the increasing dividend streams over time, it works. Now, it's a little funky with Power Shares because they're rebalancing the portfolio. The holdings in the portfolio change. They have this turnover. They're passing through taxes. There's all that going on. But despite all of that, this concept of yield on cost, it still works. It still holds up. It doesn't, I would say, hold up as good as it would for individual stocks because there's no turnover with individual stocks, at least, or next to no turnover with the strategy that I take. But there are, as I explained in my last video, pros and cons with individual stocks versus ETFs or exchange traded funds. And so I really like this question. Is I don't look at ETFs much at all. This gave me an opportunity to look into an ETF that is dividend focused, that is dividend aristocrat focused, one that I have heard members of the community speak about before. So thank you for that question. I hope this answers your question. I know there's a lot of math on the screen here, so I hope this, I hope it all makes sense to everyone. But thank you, my man Roll, for that fabulous question. And so I want to move along. We're doing more questions, just on my hustle today, on my grind, trying to get through all the questions, doing the longer videos in one setting because it's how I optimize my time. I want to get to some of my 2020 goals later to share with you why I do what I do. But anyways, I want to move on to the next question. This is question 3 for today. This is from my friend Alex. Alex, thank you for that question. And his question I'm going to put on the screen. It goes like this. Hypothetically, Ian, let's say you're 50 years old, you're about to invest $200,000. How would you go about entering the market? I love this question because I get this question a lot. Someone has a lump sum. So I want to pop some more numbers on the screen for you right now. Check this out. What you see as a table right now is how I would hypothetically invest $200,000. How I would hypothetically invest it, at least deploy it, it largely does not depend on age. It's more a function of net worth. And so what you see here is a variety of net worths. I'm going to start with these net worths. One scenario, the first scenario is, what if my net worth is the $200,000? That's my whole net worth. I got it in cash. I wanted to move it to dividend stocks. That's one scenario. Another scenario, though, is let's say my net worth is $3 million. If my net worth is $3 million and I have $200,000 to deploy in dividend stocks, I'm going to look at it a bit differently. And so the first thing I want to impart to all of you out there is you have a lump sum to invest. It's not only about looking at the lump sum. It's about looking at that lump sum and understanding how does the magnitude of the lump sum compare to your total net worth? Because it's a lot different. The logic is a lot different for someone deploying $200,000 when the $200,000 is their entire life savings versus someone who's deploying $200,000, but the $200,000 is a fraction of one's entire life savings. And so check this out. In the first scenario, if $200,000 is my entire net worth, hypothetically, I want to take less risk. And how do I mitigate risk? I mitigate risk by dollar cost averaging. And what does that mean? It means I slowly deploy money in the stock market over time. And so in scenario 1, if all I have is this lump sum and it's all the money I have, I'm going to deploy it over 5 years. I'm going to take $40,000 per year and I'm going to deploy it over 5 years. Why am I going to do that? I'm going to do that because what if the market is at its peak now and it's about to tank? I don't want to lose half of my $200,000 nest egg and put it in at the entire wrong time in the market. I want to smooth out some of that risk by deploying it periodically over time. We all know that mitigating risk, dollar cost averaging, it does just that. It helps mitigate risk. And so 5 years I feel is pretty reasonable. Maybe if my earning potential were kind of low and I never foreshadowed having too much more than this 200,000, maybe I'd stretch out that deployment schedule to a 6 or 7 year time horizon. And maybe I do that hypothetically because I know the market is towards all-time highs. Look, this market is frothy here. I'm willing to shoulder that risk because I've been buying forever and my cost basis is really low and I'm in the game forever. But it's different. If I were starting over here and I didn't foreshadow I'd have that much more than the 200, I'd be careful with it and I'd hypothetically dollar cost average like crazy, which I show here. But let's say my net worth is 400,000 and let's say so I'm deploying half of it here, 200. I already have 200,000 somewhere else, probably, dividend stocks or somewhere else, and I got a 200,000 lump sum. How am I going to deploy it? Well, maybe if it were only half my net worth, I'd take 4 years instead of 5. I'd just do 50 per year. Let's say it was 33% of my net worth, or roughly 1/3. Maybe then I'd take 3 years to deploy it. I'd deploy 67,000 year 1, 67,000 year 2, 66 year 3. You quickly start seeing as the percentage of net worth goes down, I take less years to deploy it. If I hypothetically had 3 million net worth and this 200,000 would only represent 7% of the pie of the total, well, I'd probably just put it all in year 1. Maybe I wouldn't put it all in day 1. I'd deploy it throughout the course of the entire year, but that's how I would look at it. And so the key here for anyone asking themselves this question is to think, hey, I got a lump sum to deploy. How much of that lump sum does it represent of my net worth? And looking forward in the future, am I going to earn a lot more money or not? Answering those two questions will help anyone come up with their own schedule to dollar cost average over time. And personally, when I dollar cost average, you've seen it in real time. You've seen it on my Twitter. You've seen it on this channel. I like to dollar cost average throughout the course of the year. I'm always buying. No commissions anymore, and so it's easy to do that, although I don't like really small tranches just because it's an accounting nightmare, and so I like to wait till I have a reasonable amount of money to make a little bit of a bigger buy order. But anyways, even within a year, like let's say the 3 million scenario, I wouldn't deploy it all day one. I would even it out throughout the course of the year. I'd try to buy what's on sale. I'd try to kind of value cost average in and do my best with that. But this is a really good question, again, because I get the question a lot. I think a lot of people struggle with this question. And there it is. There it is on paper for anyone who is in that situation of lump sum investing. And hypothetically, this is how I would hypothetically do it if I were in these types of particular scenarios. But again, everyone is in different scenarios. And I would say certainly the age factor plays in a little bit. I'm kind of approaching it through late 30s because that's where I'm at. Maybe if I were older, further along in life, less risk. Whenever you get older, one wants to generally take on less risk because the risk of losing principal and having to wait to build it back, it's greater. And so certainly age probably has some role in here as well. And so I kind of discounted that at the beginning, but the older one is maybe the dollar cost averaging, it stretches out a bit. And so it helps stretch it out more as well. Hope this helps, Alex, for your particular question. Thank you for asking the question. I think it's really relevant to the entire community out there because I get this question a lot. So thank you for that one. All right. So next question. This one comes from my man, Dave. Thank you, Dave. This is a really good question. I'm going to pop it on the screen. Dave is asking, Ian, this is a little off topic. No, it is not, my friend. This is a good question. What do you think of buying fractional shares as a way to get more diversified as an initial tranche to get into higher price per share stocks? Can you make that topic part of one of your videos? Oh, yes, I can. So I love fractional shares. I've been an advocate of fractional shares forever. And I'll tell you, I'm going to do this through the lens of dividend reinvestment plans. These don't get a lot of spotlight these days, but basically before there were these disruptive apps back in the day. The disruptive app was the dividend reinvestment plan, or the direct stock purchase plan. And what these plans allowed investors to do was to buy stocks directly from companies, and they could buy fractional shares, oftentimes for low or no commissions. The beauty of fractional shares, obviously, is if you don't have enough money for a full share, you can buy fractional share. Or, quite frankly, if you have enough money for maybe just over a full share, like a share and a half or a share and a quarter, you can do that. You don't have to buy just one share. You can round up and buy one and a quarter shares. Fractional shares are beautiful because it allows investors to deploy dollar amounts, fixed dollar amounts, rather than finding, rounding to share amounts and deploying weird dollar amounts. For me, I always looked at stuff as deploying round dollar amounts. It's like, hey, can I buy $200 worth of stock? Can I buy $500 worth of stock? Can I buy 1,000 worth of 3M? I don't care how many shares it is. Just give me 1,000 worth of 3M and give me the fractional shares. Make it that round $1,000. That's how I've always looked at things. And so for me, fractional shares, it's always been part of the game. It's always been part of my mentality. And so fractional shares, whether you're a smaller investor, bigger investor, I totally think, in my personal opinion, humble opinion, it's the right way to do it. It's the best way to do it. It's how I've always looked at it. And thankfully, brokerages are starting to really embrace this. They embrace it with dividend reinvestment. And now Charles Schwab, for example, is embracing it as well, or will be embracing it with share purchases as well. My understanding is in the future, or I don't know quite when, they're going to allow investors to buy fractional shares. And so, yes, to answer your question, my man Dave, I love fractional shares. I think they're good. And I'll tell you why I like them so much. For me, it's always been important to stay in the game. I don't like to deploy such small amounts that they're not meaningful. But again, it all comes down to someone's net worth. Everyone's net worth is different. A certain dollar amount means different things to different people's, and it means different things to different people's living expenses as well. And what it really comes down to is buying fractional shares that allows investors to stay in the game. It allows investors to always be buying, to always be focused on the dividend game. And if you look at me, I'm always buying stock. Check it out on my Twitter. I'm always averaging in because I got to stay focused, laser vision on my goals. And that's what I do with my constant buying. And so fractional shares have long been a tool in my toolkit. I continue to embrace fractional shares. I love fractional shares. And so, yes, to answer your question, there is no shame in going the fractional share route. And for investors that can't afford a full share of certain stocks, especially higher price stocks like Apple, why not go with a fractional share route? For example, there with no commissions these days, someone can buy $100 worth of Apple or $50 worth of Apple. Fractional shares as well work really well for younger investors that might be in their teenage years or 20s. It also works really well for kids. If you're a parent like myself and buying shares of stock for children, on their behalf, fractional shares can work really well. For example, you want to buy a certain dollar amount of stock for your kids for the Christmas gift. Fractional shares, it makes a lot more sense when you may be deploying smaller dollar amounts for kids, or just round dollar amounts, certain dollar amounts. And so, again, I love fractional shares. Really, really good question. So I want to now do two things. My last question is about my Air Jordan collection. So I'm going to share that with you all today, Thug Life. But before I get into that, I want to actually just insert my 2019 goals and 2020 goals, because I said I was going to do this in the last video. I ran out of time because I was going up against the 1 hour mark. And so I want to put this on the screen now. I want to share with you all how I'm doing against my 2019 goals and what I'm looking for in 2020. And this isn't just dividend goals. This is all goals. This is like life goals. And the reason I want to share this is this channel is meant to be inspirational, not just on a dividend level, but on a life level. And I want to challenge each and every member of this amazing community. I love you all to be your best, to be high performers in all aspects of life. And I want to share this because it's important, because we all tend to get a little bit obsessed with dividends. But if you only think about dividends, stuff compromises. I have learned this lesson so many times being a parent, because when you're a parent, you have less free time. When you have less free time, you learn in any given day, you're probably only going to get 1 or 2 things done, even though you want to get 10 things done, because time is so limited. And so you have to really prioritize. You have to think of life holistically. And you have to be careful about obsessing about dividends too much because there's other areas of life. But anyways, I want to share about 2019, 2020, let you know where I'm at, both from a life perspective and dividend perspective. So check it out. 2019 goals. My first one was about health and fitness. I would say I succeeded in that goal. I gave it a green box, a result of yes, because I did take my health and fitness to the next level. I've been running. I've been regularly doing a lot of half marathon style runs on, not every week, but every few weeks. And I've been running a lot, swimming a lot. I would say generally my fitness has been good. So I gave it a green box. That being said, I have to be careful. The last month or so, I've been tapering off doing less training because I've been obsessing more about a new real estate deal that I've locked up. I'll talk about that in a minute. And that pursuit of money and pursuit of my professional career has taken away a bit from my fitness. It's temporary, it's okay, but I got to be careful about that. And that's the ebb and flow of these types of goals, and why it's all a matrix, quite frankly. I've learned this as a parent. There's really one or two things a day. And because I'm so focused on my professional career these days, lately in the last month or two, my fitness, I have to be honest with myself, it's taken a little bit of a hit. The reason I'm doing this also, honestly, here on YouTube, is so many of us are not self-critical enough. We're all cheerleading ourselves. I see a lot of stuff out there just on the internet celebrating wins. We need to celebrate our failures as well. And so I want to share failures with you. Check this out. This year, I want to take my husband and father skills to the next level. On the one hand, I did a good job. We had a lot of family vacations. We went to Hawaii twice. I had 2 times. I had good experiences. But I'll be honest with myself. I put a red box there and an okay. I didn't do that good on husband and father skills this year because I was so focused on my dividends, my YouTube, my professional career, my YouTube, my all of the stuff that, I'm going to be honest, there's only so many hours in the day. I probably could have spent more time with my kids. I probably could have spent more time with my wife. And so, quite frankly, one of the reasons I didn't do so well on this goal as well is it wasn't really a SMART goal and I didn't have specific measurables. And so as we roll into 2020, I'm going to do a repeat of this goal and I'm going to have it a little bit more measurable, and I'm going to journal on it too and have a little checklist each day. So I hold myself more accountable. But yeah, this goal did suffer a little bit this year. That being said, other stuff succeeded because it suffered, and those things that did succeed are setting my family financially up for success in the future. And so in one respect, I did kind of take one for the team in the sense that I worked my butt off for the financial side of things, which will hopefully pay off really well for our family in the future. But again, I would say it's an okay, but it's a red box because anything that's not a yes for me is a failure. Let's move on. Write a book. Complete failure. I basically failed to get started. I know a lot of you want a book. I even said I'm going to do a book. I didn't get around to writing the book. I started here and there writing this chapter, that chapter. I didn't even like what I was writing. It wasn't good enough. My standards are high. You've seen here on YouTube, I raised the bar a lot. It wasn't good enough. And so I'll tell you something else. And this is where I'd love to hear in the comments below. Let me know if you'd actually buy the book, because I'll tell you, I rolled out my merch this year. I love my merch. I have actually a Black Friday sale right now. It's good through the end of this week, so check out my merch store. I'll link in the description below. Got a bunch of new merch. So thankful because I've gotten a lot of orders. But I'll tell you, from a raw orders standpoint, I'm thankful. I'm blessed. I love you guys who have ordered it. Thank you. But I'll tell you, it's not that many orders. And so the reason I've kind of been slower on the book is, look, if this book cannot sell, say, 10,000 copies or more, I'm really not best served to invest my time in it from a dollars and cents perspective, because there's only so many hours in the day. And from a life perspective, do I want to take time away from my wife and kids to write a book if it's not going to sell, say, 10, 20, 30,000 copies or more? Probably not. And so the challenge I have here, using the test scenario of my merch and seeing how much merch I've sold, and again, I don't want to discount it because I know so many of you have supported me And I hope you enjoy the merch as much as you do. I love the t-shirts and the merch because I have sweatshirts now, by the way, hoodies, mugs, long sleeve t-shirts. Check out the store, new merch, new good stuff. I'm having new designs in the coming months too as well, because I just love this stuff. It's just fun for me. And I honestly, a lot of the reason I do the merch is for myself, because I like to wear it proudly in the videos and just around town, enjoying life. And it washes well too. I'll tell you, the Teespring store, I've washed my Thug Life shirt, my Dividend Investor shirt a few times now. Logo still looks good, so quality's been good. And I've heard that feedback also from some of my customers, some of you all. Anyways, I don't want to discount that because I love you, but I'll tell you, given how much merch I've sold, it's been good, but I'm telling you, it ain't 10,000 items. And so just share in the description below or in the comments below, especially if you're someone that decided not to buy merch, but you would buy a book. I'd like to hear about that. And it may, I just don't know. I'm kind of at a crossroads with the book, to be honest, because of all of the challenges I have with time. It's so limited, but that's where I'm at. It's a fail, conscious failure. I'm okay failing. I have 10 goals going into the year. I know I wasn't going to hit all of them. And I don't want to make it too easy. I have 10 goals because I'm supposed to fail on some of them, and it helps me prioritize. Number 4 is a failure. I wanted to hit 100,000 subscribers. I hit, I think I'll close out the year at 50. Bless you all. I love you all. This is conscious. Look, I put okay here, but again, anything that's not a green box to me is fail. That's why it's red. I'm happy getting halfway to that goal because I know I'm only doing the videos once a week. I'm doing these long hour-long videos. It's not for everyone. I'm in it for the culture. I'm in it for the people who've been here since day one. I'm in it because for the meetups. I love you guys. And so the thing is I can only do one video a week now. I have to do them in this format. It's the only way I can prioritize my time and make it all work with my life, with my prioritization. I realize this format, maybe it won't get me as many subscribers as I could do with the shorter videos. So be it. But I still have my goal of 100,000. Hopefully I'll hit it next year. I love you all. But again, hey, didn't hit my goal. So let's move in. The reason I'm showing you this stuff is if you didn't hit your goals, don't feel so bad. 1, there's a month of time left. 2, if you're hitting all your goals, you're not challenging yourself enough. This is a community of winners. This is a community of high performers. High performers have to challenge themselves. And so check this out. This is the goal I am most proud of. You guys know I'm a commercial real estate developer. I've shared some photos of the property I'm developing right now in the past on Instagram on my channel here. I got another property in escrow, and I am working really hard right now on planning for developing, getting entitlements and such for this property. This is where I'm spending a lot of time. This is a resounding yes. This is my biggest success of the year. I did it. I'm excited about it. This is just an exciting success for me. And honestly, this is why my health and fitness is a little less these days. This is why my YouTubing schedule, quite frankly, has changed to once per week, longer videos, because I got to find the time to basically do a whole new deal. I was up late last night just working. Mr. 25/8 like DJ DMD. All right. Number 6 is a success. I became a car detailing pro. I'm detailing cars. I have the added benefit of detailing my own cars that I'm saving money and working on my physical fitness, because detailing cars, you're doing a lot of bending, squats, using your arms, using your legs. It's a lot of work. It's good exercise. Number 7, obviously it's a yes. Yeah, I'll never stop. Can't stop, won't stop, like my man P. Diddy. No, I'm never going to stop deploying money in dividend stocks. So yeah, that's a yes. Number 8, take time for myself and my hobbies. Huge fail. Maybe my biggest failure this year is not taking any time for myself, grinding it out. A lot of you have noticed, Ian, it looks like you got bags under your eyes. Ian, take care of your health. I want you here on YouTube for a long time. I thank you all in the community looking out for me, because I kind of needed that. At least I got some good sleep last night. I need to work on my sleep, my health, because I'm working too hard these days and can't go on forever. But it's a huge fail. I'm not taking care of myself, everyone, from a sleep perspective. And I'm one of these people that can't stop, won't stop. But it's going to catch up one of these days. And so take a lesson. You don't want to necessarily follow everything I do. I definitely got the bags under my eyes. I'm working too hard. So that's a fail. Next one, give back. Yeah, gave back. Did a lot of charity this year. Donated a lot of money. Feel good about that. And I have a website, lowpuck.org. where I document all my charitable contributions. Haven't updated it for a while, but I will do that before the end of the year. It's on my list. I just got to take some time to do it. Okay, embrace spirituality, fail. Didn't do it. A huge failure, didn't do it. And so that's my 2019 successes, failures, feel good about it. Again, spirituality, why didn't I do it? I was just focused all year on the stuff I did do. And so there's only so much time, can't do it all. Where does that leave me for 2020? Pop it on the screen real quick. Want to jump through this quickly. I am making smarter goals because it's going to be easier for me to hit these goals. If I make them smart, I can make checklists, I can journal, I can check off clearly if I did it or not. Goal 1 is my health and fitness. That comes 1. It's funny. It's more fitness. It's not health because like I just said, my health, I ain't getting sleep. I got to work on that. Fitness, all good, and it'll continue to be all good. But for my fitness, I want to continue to do these things that I list here, run 12 miles a week, 2,000 yards swimming, weights, all that good stuff, and I'm going to check it off. It's going to help me stay even more focused. I want to do 1 hour of undistracted kids time per day, playtime, and dates twice a month with my wife. Undistracted means no phone. I have an issue with the phone. I'm always on my phone. I'm always, look, I'm a shareholder in Apple. I'm a shareholder for a reason. You can't get off these phones, everyone. And so I got to be undistracted, and I want to make this measurable so I can check it off on the list each and every day as one of my goals. I want to find a church, and because the church we used to go to no longer is in existence. We have not been attending church. I need to find a church, and we need to start going. We got to do that. We got to make spirituality happen. And so that's a big goal as well. You'll see top of my list, not even talking about money here. There's more important things in life, everyone. This is why I'm sharing this on my Dividend channel, because I think sometimes we all get a lot caught up in the money, especially me. That's why I'm up all night, and why I'm working so hard. I want to do my 5-minute journal. Meditate daily and get at least 7 hours of sleep per night. And so I need to challenge myself in all of these. Okay, finally getting to the money stuff. I need to get my real estate deal that's in escrow done. Biggest money goal of the year. That's what I'm going to do. I want to consistently deploy more money in dividend stocks. Obviously, that's going to be so easy. My focus on dividend stocks 2020 is going to be current yield. The reason that's my focus is I want to start using more and more current yield to pay bills, and I want to do that to buy time. I want to buy more time so I can focus on goals 1 through 4, because that's really what it's all about in this life. And so all ties together, but it's all about current yield for me in 2020. And I'm not discriminating, top 10, top 20, anything's fair game, stocks 1 through 43. If there was another sub goal on my dividend investing for 2020, it's going to also be bringing smaller positions to size. So I got a bunch of smaller positions, newer positions, they're a bit smaller, bring them to size. And so that's going to be a sub goal of my dividend investing as well. Another one, no net new positions. I don't want to be adding more complexity in my life. So if I add a net new position to my dividend portfolio, I need to sell a position first. And so that's something to keep in mind. 100,000 YouTube subscribers, more meetups. I love the in-person FaceTime with you all. I'm going to do more meetups. And I have a Los Angeles meetup coming up, by the way. I'm really excited about that. All of you on my local crew, you're aware of that. I have a lot of RSVPs already, so I'm excited about that. More meetups in 2020. I can't wait. I want to donate more money to charity. I just set a goal here of 10% more. And so I want to make my goals a little bit smarter. And so each year for the last few years, I've been doing the same amount to charity, more or less. And it's a good amount, and I'm proud of it. It's a resounding success. But 2020, I want to raise the bar by 10%. And so I put question mark here. Put in the comments below if you want a book. I'm just kind of saying at this point, I got to be able to do a massive volume of sales to be able to rationalize the time that goes into the book, because it will compromise goals 1 through 4, which are the top 4 goals, and they're all related to health, spirituality, wellness, all the good stuff that family, all the stuff that really matters. And so anyways, the money stuff, the dividend stuff, I love it so much. The real estate stuff, I love it so much. It supports all of that stuff. But that's that. YouTube, by the way, I'll tell you, the reason I'm prioritizing meetups is that honestly ties into goals 1 through 4 as well. It's part of the wellness. when I get to sit down face to face with you all, and when you all get to sit down face to face with each other and we have these meetups, I put that under the bracket, under the bucket of wellness, because it makes everyone engaged, excited, friendships occur. It is awesome. And so that's that. And so anyways, I'd be curious, share in the comments below, what are your goals for next year? How did your goals go for 2019? Just being open with the community here, and honest with myself and all of you as always, because we got to stay accountable and we got to celebrate not only the success, but the failure, because we can learn so much through the failures. That's how we learn. That's how we jigger our life. And like I said, it's impossible to succeed on all the goals. You got to fail, because if there's unlimited time, that'd be the only way to succeed on all of the goals. So before I leave today, another question from my man, Paul. Ian, can you do a video of your Jordans? Yes, I can. And so I'm going to share some Jordans with you all. I'm going to go real quick here, but for all you sneaker heads out there, as Raekwon would say, what you keep spending your money on, I want to share some sneakers with you all really quick today. All right, so I got the Jordans in front of me, big stack here on the side. I'll go through them. Now, let me tell you, this ain't no Jumpman Bostic channel. I don't have that many sneakers. I'm a dividend investor. I got to be careful with my money. I got to save my money. I got a lot of other shoes as well. I like other types of shoes. But what I'm trying to say here is the Jordans I do have, I enjoy them and I love them. I treasure them. I respect them. And the purpose actually of sharing my collection is, you'll see, it's not that big. It is what it is. I buy the Jordans that I can enjoy and love and respect, while still saving most of my money, the huge lion's share of my money, for investing, because I don't need to have thousands of pairs of Jordans or hundreds of pairs of Jordans to enjoy life. I'm just fine with the ones that I have. And what I would say along the way, a critical part of all of this dividend investing and this financial stuff is to reward oneself along the way. So I just rewarded myself with actually 2 new pairs. One is still on the way. One I have to share today. But early Christmas gift, if you will, to myself. So I reward myself along the way, because it helps me stay motivated and committed to my dividend strategy and enjoy life along the way, without being too materialistic and having just like too many Jordans, because that would be, in my opinion, not a prudent use of money. Anyways, let's look through them. And so first one I got here, what is this? This is a Jordan 13, or size 13 for retro. So, oh yeah, this is the one that I just got. So this is the early Christmas gift to myself. This is the gray one. What do they call this? I'm not going to even remember all the names for the video today. I'm not a sneaker guru like some of the other channels out there, but I just want to share. There it is, cool gray. So it's a Jordan 4 cool gray. This is actually my favorite Jordan, the Jordan 4s. They're the most comfortable for me. Thankfully, I work in a job where if I'm not on the job site, I have liberty to work at a coffee shop like Starbucks, for example, or at home, or wherever, quite frankly, I want to. So I can get by day to day wearing a comfortable shoe like a Jordan. So this is the cool gray. This is a 4, retro 4. This is the one actually that I just received and started wearing today when I was prepping for this video earlier today. This is my new Christmas gift to myself. And I have one other in the mail on the way that hopefully will arrive here any day. It's actually going to be a retro 11. And it's the low top. So that actually brings me to this one. This is another Jordan here. This is the retro 11. It is a low top. These are a bit dirtier. I need to maybe clean them a bit. It's not too bad, but it's a low top retro 11. I like the low top retro 11s because basically I can get away wearing these with like a dress pant or dress outfit. And so if I'm actually I am going into a corporate office setting, which I do sometimes, I can get away wearing something like this and keeping my feet comfortable. What I've learned as someone in my late 30s is I still can wear dress shoes and such, but at the end of the day, these days, it's all about comfort for me and style and just enjoying life. And hey, I love the Jordans. It's something I grew up around, grew up with. It's part of the culture. You know, I'm a Thug Life investor. You know, I love hip hop music. It's all, you know, I love Carl Kanai, Cross Colors. It's all part of the culture. I enjoy it. It just makes me happy. So these are the ones I wear if I'm going into the office. And I ordered another pair of these low top 11s that hopefully will come in the mail now soon. It's the snakeskin style ones. That was kind of my Black Friday gift to myself. Again, I don't get too carried away with this stuff though, because like I said, most of my money I got to save for dividends, and this is just a kind of nice to have hobby of mine. Anyways, what have I got here? I got the Jordan 4s. Again, another 4 retro. So, these ones I like. I think these were called like the motocross ones. These are from a while back, but I really like these ones. They're just the color scheme with the blue and the white, the black. They just look really, really fresh. I like wearing these with jeans. Again, this is kind of my shoes, go-to shoes I'll wear on a daily basis. Just when I'm out doing stuff, I enjoy the Jordans. And the 4s, for whatever reason, the 4s fit my foot well. The 5s, which are actually my favorite, they don't really fit that good, even though I have a pair. I'll show you. Anyways, what else have I got? I'm trying to go quick here because I know this ain't a sneaker channel, but the 4 retro. Here's another 4 retro. So, these are my favorite pair of Jordans I have. These are called the Royalty. It's the black kind of nubuck suede stuff with the gold accents. These are just really awesome shoes. I've actually worn these shoes before with like a suit. Look, I just don't care. It's kind of like with AbbVie. Some people call it Humira. I call it Humira. I don't much care because I own the thing. It's kind of the attitude I got these days. Dividend investor. Look, I made it this far in life. I got kids. I've been through it all. I wear this with a suit. I just don't care what people think. I love it. And so, just how it is. And so those are my favorites. I just absolutely love those Jordan 4s. Man, more Jordan 4s. Okay, so as far as kind of something maybe collectible goes, maybe these are the ones. These are the white cement 4s. I don't wear these a lot because, one, they get dirty easy, but I would say if someone was like a collector, maybe these are the ones that would be most appealing to them. Man, this embodies that 90s style. These are the white cements. I kind of wear them on special occasions if it's date night or something. And so I love these. Man, these are just awesome shoes. And so those are the white cement 4s. And then what have I have left? So I have one pair of 5s. I don't know what they're called, but they're I don't know. Again, they all have the names. I apologize for not being up to speed on all the sneaker names. But these are my 5s. The reason I got these, it's like the black kind of nubuck suede with the silver and clear accents. 5s are cool. They have this little lace gizmo here. It keeps the lace in place. These are not very comfortable for me, and so I can barely wear these at all. Honestly, I might just get rid of them at some point. Sell them on eBay or something. The reason I keep these, though, is it reminds me of my childhood. When I was a child, I did have these exact shoes. Favorite pair of shoes of all time. Loved these things. Was blessed that my mom bought these for me back in the day. Thank you, Mom. We loved shoes when we were kids. That's probably one of the reasons I enjoy these shoes. It's just the nostalgia. When we were kids, actually, we were at school. We'd actually trade shoes sometimes. We were like, hey, like I'd wear my buddy's shoe for the day and he'd wear mine. We had more or less similar shoe sizes, and we were just kids enjoying shoes. But we had like back then, like one of our friends had the Reebok Pump, which was really popular. And anyways, one of my friends had the Bo Jacksons. Those were really popular. And so we enjoyed our shoes, and it was just a fun part of childhood. But this was it for me. Man, this was just something special. And so as an adult, I had to own it. But I'll tell you, I can wear the 4s. I can't wear this thing. It's just not comfortable for me. And so that's a shame. But I don't know. Maybe I'll keep it just because it's literally the shoe that kind of defined that stage, that part of my childhood that I remember very, very fondly. Anyways, that's my Jordan collection. I hope you enjoyed it. I know it's not that impressive, but I know some of you wanted to see. I do love what I got, and I'm proud of what I have, and I'm picky. And it's just one of my ways I make life fun because, again, it can't always be all about dividends. And so, before I leave today, a full disclosure, I am long the stocks I mentioned. I own shares of 3M, ticker symbol MMM, Duke Energy, ticker symbol DUK, Apple, ticker symbol AAPL, and AbbVie, ticker symbol ABBV. And, oh yeah, Starbucks, ticker symbol SBUX. I love you, Starbucks. In terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest, please consult a licensed investment advisor first. And make sure to check out the disclaimers in the description below as always. I love you all. happy holidays. I am sending all my best to all of you. I will see you all in the next dividend investing video.